Nigerian Securities and Exchange Commission has directed fund managers to adopt mark-to-market valuation for bonds, aligning asset values with current market prices rather than original purchase costs. While the reform is expected to improve transparency, enhance liquidity, and make Nigerian fixed income assets comparable to global benchmarks, analysts warn the shift could expose investors to price swings previously hidden under the hold-to-maturity model. Joining me for more on this, I have with me Oladipo Ajayi, Head, Fixed Income and Forex at Chapel Hill Denham. Thank you so much for joining me today.
Good morning. Thank you very much for having me this morning.
All right, quickly, talk to us about, what this directive entails and what necessitated this shift.
Well, when you look at what is globally the global standard is more like the mark-to-market standard, and what the Securities and Exchange Commission is trying to do is to actually align what is globally acceptable. When you consider normal asset management process, of course, it should be mark-to-market standard, because what you actually bring to the table is to ensure the right valuation at any point in time. Just imagine you having a security, an equity portfolio, and you were holding the security at maybe a price at which you bought several years ago. And currently, the price has changed. Of course, when you are still reporting at an old price, of course, it's not giving the market the true valuation of your portfolio. But when you actually mark the market on a regular basis, what that does to you is that it actually shows transparency, it actually depicts the revaluation of your portfolio. And that's exactly what the Securities and Exchange Commission is trying to do. They are trying to actually ensure that every asset manager, whatever you are reporting, is more like the revaluation of your portfolio rather than the historical valuation.
All right, so talk to us about the implications of this shift, whether for the market, for participants, and also the economy. I'm asking because we know that some market participants are already beginning to complain, saying it would influence some level of volatility. And, I would like you to speak to us about this.
Of course, one of the things that this will bring to the table is a high level of volatility. To be realistic, market is not static, and to be fair, we are not expecting a market that is static over time. The same way the equity market is volatile, the same way the fixed income market is also very volatile. But the only advantage that the fixed income enjoys is the fact that no matter the level of volatility, you can now compare what's happening in the fixed income market with what's actually happening in the equity market. So what will happen is the fact that you have to now continue to actually check the daily valuation of your portfolio. Petra, just imagine that you are the one that is holding a fixed income instrument, of course, and you bought at maybe you bought at par value, and currently the instrument is trading at premium. Of course, the valuation of your security is not the par value you bought when you were actually buying. It's more like the current valuation. And when you want to actually borrow from the bank, what you are taking to the bank as security or as collateral is not the historical valuation, is the valuation as at today. And that's what the Securities and Exchange Commission is trying to do. They are trying to actually ensure that the portfolios are actually showing their true value. Of course, there will be volatility, and part of the impact is that investors will be now see that what they used to actually see on their valuation is not the revaluation. What the revaluation is, what is currently obtainable in the market, or because it is what price can I sell this thing if I want to sell today, is not the price at which I bought when I bought. So what SEC is trying to do is that it is the price that if you want to sell now, that is the price that you actually be able to actually sell in the instrument. It's not the price at which you bought the instrument. But what we've been showing, or what fund managers have been showing their investors, is more like what they actually bought, the price at which they actually bought when they actually invested in that instrument, not where it's currently trading. So to be fair, on the part of the SEC, that is the global standard. But on the other side of it is the fact that this will open investors to a lot of volatility, and that may actually deter some people from actually investing in some funds.
Right. Now, do you reckon that the major losers in this policy would most likely be local investors, fund managers, and even the companies issuing these bonds, especially when you look at the fact that investors could face higher volatility, which we've talked about? There is also the risk of redemptions if investors panic at sudden drops in portfolio. And of course, we also have the companies that can also face higher borrowing costs in future. Isn't that something to be wary of, or we should just align with global best practices?
Truly, I get the angle at which you are looking at it. But with all that side that you have mentioned, we will not still say that it's a wrong decision to take, because when you are trying to actually align globally to what is acceptable in the global environment, and this is not only peculiar to only Nigeria, there are other emerging markets also that already are using that as well. And the impact, just as what you said, aside the individuals that they are going to actually feel the impact, there are also an element of actually cost of borrowing to corporates when they need to actually come to the market to raise funds in the market. And I agree to a great extent with that. But I also feel that it's just because we are newly starting it, and that's one of the reasons why you see that high level of volatility. Because of the fact that you need to now do more like a mark-to-market from where you used to be compared to where you are now. But if what we are doing henceforth is like when you're actually purchasing an asset, henceforth you mark it to market, the level of volatility will not be as much as what you have seen when you are holding an instrument at par value and you now need to actually mark to market at this particular point in time. And some of these instruments, when you look at where we are currently, a lot of them, sincerely speaking, they will actually be a mark to market at a discount because some people are holding some instruments at as low as 12.5%. Yield are now currently at not of 16%. So when you look at that level of differential, it means that a lot of people suffer airport, and this record will actually lead to what you actually just mentioned now. It will actually lead to a redemption of assets. But the issue is that the asset managers need to actually come together to find a way to actually educate their investors. And also another thing we also need to know is that this is the best time now to actually differentiate the men from the boys. It's a time where you can now actually differentiate a good asset manager for those that are just like to actually dabble into the business. Because this is where you can now judge expertise. Because if it's just a blanket way of doing it before, the way we're doing it before, of course you can assume that everybody's just doing the same method and not actually differentiate one from another. But with this new method now, you can now actually be able to see a good asset manager from the ones that are not.
Well, with its pros and cons, doesn't this sort of make the equities market less attractive and maybe the equities more attractive? Just saying.
Well, it is not impossible. A lot of people may actually start looking at divesting from the fixed income fund or from some of these instruments to actually come into the equity space. And one of the view is the fact that, there's this view that, the fixed income market is stable, it's not volatile. So a lot of people feel that when they actually want to do more like a risk-free investment, they can just sit down in that sort of investment. But now that it's getting clearer that, this also has an element of volatility. And it means that you can also lose money in this regard. And that will actually push some investors to actually moving to equity space. And as sincerely speaking, some asset managers, they are proactive enough, because if you look at the Chapel Hill fund, we actually do more like mark to market rather than the par value. We actually implemented that since last year. Because we already imagine that the market is getting opened up and the market is getting to a level where we need to actually be showing clearer valuation to investors. At the beginning, a lot of investors were actually very agitated because they are now comparing what we are doing with other assets fund managers. But at the end of the day, we're able to explain that the model we are currently operating and how that in the long run, it will be a better one for them. And also, when you understand very well that you are marking to market asset now, so it means that your decision in the first place, you will ensure that it's the right one. So you look beyond now, you look into the future before taking this decision. And that will also help the level of performance.
I like what you just said now, saying that we need to look into the future. So talk to us, how should investors sort of hedge against or minimize risks in the new normal, especially looking at inflation or even interest rate movement? So as a fixed income investor, what should I look at before, making moves?
Well, part of what you look at is that you look at interest rate expectation. You look at inflation expectations. For example, now, when you look at where we're currently now, the expectation that interest rate will drop in the future. If not now, in the future, we expect interest rate to drop. We've seen a bit of stability. We've seen a bit of tranquility in the economy. So it means that there's no other time for anyone to actually lock in into the fixed income space. I've been pitching this since the month of since January, when yield were as high as 22%. Currently, we are around 16.5. Imagine someone that's locked in at 22%. One way or the other, you are highly hedged to a great extent. So it means that when inflation starts dropping, or when inflation continues to drop, or when the interest rate also now continuing downward strike, it means that you are fully hedged because you have locked in at a high level. And when you're locking in at that high level, you're locked in for a long time. So that's not a time that you want to buy treasury. You are seeing yield at 22%. It's not a time that you now want to invest in short-dated instruments, because what you will expose to, you'll be exposed to investment risk at maturity. That is a very good time for you to look into a long-dated instrument like a 10-year instrument. So it means that over that 10-year spree period, you'll be enjoying a 22%. And when you average inflation, you average interest rate over that period, I'm telling you, there's every tendency that you would have done better than inflation and interest rates.
All right, thank you so much, Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham, for sharing your thoughts with us.